Today, the crypto market feels heavy, tense, and unusually quiet, the kind of quiet that usually comes before another big move. Bitcoin is trading near the $70,000 range, a level that has stopped feeling like a victory and started feeling like a test of confidence. Just months ago, investors were celebrating fresh all-time highs, record ETF inflows, and loud political promises that crypto would finally be welcomed into the financial system. Now the excitement has cooled. Fear has not fully taken over, but caution has. And that change in mood matters, because crypto is no longer driven by hype cycles alone. It is being shaped by institutions, governments, and global politics in real time. Bitcoin recently slipped below $70,000 for the first time since the powerful rally that followed pro-crypto signals coming out of the United States. This move shocked many short-term traders, but it was not caused by a sudden crash, a major hack, or a single piece of bad news. Instead, it came from a combination of profit-taking, global risk-off behavior, and growing political uncertainty. Investors who entered through spot Bitcoin ETFs are mostly still holding, showing long-term conviction, while leveraged traders are being forced out. This is how a maturing market behaves. The swings are still sharp, but the reasons behind them are more complex and more serious. Altcoins are under even more pressure. Ethereum has struggled to regain strong momentum as debates around gas fees, scaling, and competition from other blockchains continue. Solana, which had been one of the strongest performers during the recent bull phase, has pulled back sharply as traders rotate away from high-risk assets. XRP remains extremely sensitive to regulatory headlines, moving up and down based on every signal related to future policy clarity. Meme coins and small-cap tokens are quietly bleeding, reminding the market that when liquidity tightens, speculation is the first thing to be punished. Behind all of this price action is politics, and politics is no longer a background issue for crypto. In the United States, digital assets have become a real political topic. Lawmakers are openly debating how crypto should be regulated, taxed, monitored, and integrated into the existing financial system. The approval of spot Bitcoin ETFs was a historic moment. It signaled that Bitcoin is no longer viewed as a fringe experiment. It is now an asset that institutions are officially allowed to buy, hold, and recommend. That decision brought billions of dollars into the market and permanently linked Bitcoin to traditional finance. At the same time, the U.S. government is increasing pressure on illegal crypto activity. The Department of Justice has made it clear that it is targeting criminal networks that use digital assets for money laundering and cross-border crime. This has created a strange balance. On one side, crypto is being legitimized for investors and institutions. On the other side, surveillance and enforcement are becoming stronger than ever. For long-term holders, this is not necessarily bad news. It suggests crypto is being absorbed into the system rather than pushed out of it. While the United States debates regulation, China is moving in the opposite direction. China has once again expanded its crackdown on cryptocurrencies. The latest measures go beyond trading bans and now target crypto advertising, real-world asset tokenization, and even technical services that support crypto networks. This confirms a long-standing pattern. China does not want decentralized digital assets competing with state-controlled systems. Each time China tightens restrictions, the global market reacts briefly and then stabilizes. Bitcoin has survived every Chinese ban so far, and investors increasingly see these announcements as noise rather than real threats. Crypto companies themselves are also adjusting to this new environment. Gemini, the exchange founded by the Winklevoss twins, recently announced significant layoffs. While job cuts are never positive headlines, they reveal an important reality. The era of unlimited growth, easy money, and unchecked expansion is over. Crypto businesses are being forced to operate like real financial institutions, focusing on efficiency, compliance, and long-term survival. Historically, this kind of restructuring often happens before the next phase of sustainable growth begins. Another layer of controversy is forming around crypto and political influence. In the United States, criticism has emerged over foreign investments connected to crypto ventures tied to political families. These stories raise serious questions about ethics, transparency, and influence. Regardless of how these cases unfold, they show one thing clearly. Crypto is now powerful enough to attract geopolitical attention. Governments care who controls the infrastructure, who profits from it, and who sets the rules. That alone proves crypto is no longer a niche market. For Bitcoin specifically, the long-term narrative has not changed. The supply remains fixed. Institutional demand continues to grow. Political uncertainty keeps pushing investors toward assets that exist outside traditional monetary systems. When inflation fears rise, Bitcoin benefits. When trust in governments weakens, Bitcoin benefits. When regulation becomes clearer, Bitcoin benefits again because clarity invites capital. The short-term price action may be violent, but the foundation underneath is stronger than it has ever been. Many retail investors are asking whether this marks the end of the bull market or just a temporary pause. History suggests that pauses are normal, especially after aggressive rallies. Bitcoin has experienced multiple cycles where it dropped 20 or even 30% before consolidating and moving higher. What makes this cycle different is the presence of ETFs, asset managers, and political stakes. These players do not trade emotionally. They think in years, not days, and their involvement changes how the market reacts to fear. Altcoins, however, will not all survive this transition. Regulation is likely to separate serious projects from hype-driven experiments. Blockchains with real use cases, active developers, and regulatory compatibility stand a better chance of surviving long-term. Others will slowly fade away. This is not necessarily bearish, it is evolutionary. Every major financial revolution goes through a cleanup phase where weak ideas are filtered out. The most important takeaway from today's crypto news is not the exact Bitcoin price. It is the realization that crypto is now fully intertwined with global politics. Elections, regulations, international conflicts, and enforcement actions are moving markets as much as software updates and network upgrades. For investors, this means staying informed is no longer optional. Ignoring politics in crypto is no longer possible. Bitcoin is not dead. It is not collapsing. It is growing up. Growth is uncomfortable. Prices shake weak hands. Headlines scare late entrants. But beneath the noise, adoption continues. Governments argue because they cannot ignore it. Institutions invest because they cannot dismiss it. Individuals around the world continue to buy, hold, and build because they believe in a financial system that is open, borderless, and resistant to centralized control. If you zoom out, today's volatility looks smaller than it feels in the moment. What truly matters is that crypto has crossed a critical threshold. It is now part of the global power conversation. Once something reaches that stage, it rarely disappears. It gets controlled, integrated, or reshaped. Bitcoin was designed to resist control, survive integration, and adapt under pressure. That is why every dip feels dramatic, yet every cycle ends with crypto standing stronger than before. For new investors watching from the sidelines, this moment is a lesson in patience and perspective. Markets tied to innovation and politics do not move in straight lines. The fear visible today is the same fear seen during past corrections, and each time it eventually turned into opportunity for those who understood the bigger picture. That does not mean blind optimism or reckless buying. It means understanding why prices move, who influences them, and what incentives shape decisions behind closed doors. Crypto is no longer just about charts and code. It is about power, regulation, and narrative. Those who understand all three gain an edge that most traders ignore. Short-term noise will continue. Headlines will flip sentiment overnight. Social media will exaggerate every move. But beneath it all, the infrastructure keeps expanding. The user base keeps growing, and capital keeps flowing in quieter, more strategic ways. That is how lasting financial systems are built. Not during hype, but during uncertainty. In the months ahead, clarity will matter more than excitement. Policy announcements, court rulings, and international coordination will shape the next major trend. The investors who survive this phase will not be the loudest voices on social media. They will be the most informed, disciplined, and emotionally controlled participants. Crypto rewards those who respect time, risk, and reality. Today is not about predicting tomorrow's price. It is about understanding where the world is moving and positioning calmly before the next wave arrives.